From Wall Street power players to everyday investors scrolling through Reddit and TikTok, one term is generating a massive buzz: crypto ETFs. But if you're new to the world of digital assets, it can all sound like financial alphabet soup. What even is a crypto ETF? How does it work? And why are so many people saying it's the gateway to the next big wave in crypto investing? In this episode of Crypto Made Simple, we'll walk you through everything you need to know about crypto ETFs, what they are, how they work, why they're making headlines, and how they might be the easiest way for beginners to step into the world of cryptocurrency without the hassle of private keys, wallets, or exchange accounts. This isn't just another finance trend. Crypto ETFs could reshape how millions invest in digital assets for years to come. So whether you're a total beginner or just crypto curious, you're in the right place. Don't forget to like, subscribe, and hit the bell so you never miss an update on the future of finance. Let's get started. In the fast-moving world of finance and technology, one term has recently been making waves across both Wall Street and Main Street: crypto ETFs. If you've heard the phrase but aren't quite sure what it means or how it could fit into your investing journey, you're not alone. Crypto ETFs are one of the most significant financial innovations in recent years, blending the world of digital currencies with the structure and stability of traditional investing. But what exactly is a crypto ETF? How does it work? What are the benefits and risks? And most importantly, should you be paying attention? In this video, we're going to unpack everything you need to know about crypto ETFs in a simple, clear, and engaging way, whether you're brand new to investing or already curious about crypto. ETF stands for Exchange Traded Fund. It's a type of investment fund that's traded on stock exchanges, just like regular stocks. But unlike a stock, which represents ownership in one company, an ETF holds a basket of assets. This could be stocks, bonds, commodities, or a mix of different investments. Imagine an ETF as a shopping basket. Instead of buying individual ingredients, you buy the whole basket. When you invest in an ETF, you're essentially owning small pieces of everything inside it. ETFs offer investors diversification, lower fees, and easy access to different markets, all in one simple investment vehicle. And the best part? ETFs are highly liquid. You can buy and sell them during regular market hours using your favorite trading app or brokerage platform, just like buying shares of Apple or Tesla. So where does crypto come in? A crypto ETF is simply an exchange-traded fund that gives you exposure to one or more cryptocurrencies, like Bitcoin, Ethereum, or even a combination of digital assets, without requiring you to own or manage those cryptocurrencies directly. In other words, if you want to benefit from the price movements of Bitcoin but don't want to deal with crypto wallets, blockchain addresses, or security risks, a crypto ETF gives you a much simpler alternative. Instead of buying and storing crypto yourself, you just buy shares of the ETF. The ETF, in turn, either holds the actual crypto or invests in products like futures contracts that mirror the price of that crypto. Now here's something important. Not all crypto ETFs are the same. They come in two main types: spot ETFs and futures ETFs. A spot crypto ETF holds real cryptocurrency. If it's a Bitcoin spot ETF, the fund actually buys Bitcoin and stores it in secure institutional-grade cold wallets. The value of the ETF reflects the real-time price of Bitcoin, and when the price of Bitcoin goes up or down, your ETF shares follow. This is the most straightforward form of crypto exposure. Then there are futures crypto ETFs. These don't hold any actual Bitcoin or Ethereum. Instead, they invest in futures contracts, which are legal agreements to buy or sell crypto at a specific price on a future date. These ETFs aim to track the crypto market's performance by betting on where the price is headed. While both can offer exposure to crypto price movements, futures ETFs can be more volatile and less accurate in tracking the real-time price of the underlying asset. They may also involve higher costs and complex financial mechanics like contract rollovers and contango. So why are crypto ETFs such a big deal? For years, investing in crypto meant diving headfirst into a whole new ecosystem. You had to open accounts on crypto exchanges, learn how wallets work, protect your private keys, and be your own bank. It was exciting but intimidating for many. Crypto ETFs solve that. They allow people to get involved in digital assets without needing to learn all the technical steps. If you know how to buy a stock, you already know how to buy a crypto ETF. This opens the door to millions of everyday investors, and perhaps more importantly, to large institutions like pension funds and hedge funds. These players often have strict rules about what kinds of assets they can hold, and many can't directly invest in crypto. But a regulated ETF? That's a green light. That's why some of the biggest names in global finance, like BlackRock, Fidelity, and Grayscale, have jumped into the game, creating and managing crypto ETFs for the mass market. In the US, the first Bitcoin futures ETFs launched in 2021. But the real excitement came when the SEC approved spot Bitcoin ETFs in early 2024, a move that many believe marks a turning point in crypto's integration with the traditional financial system. And that's just the beginning. Ethereum ETFs are on the horizon. Multi-asset crypto ETFs are coming. Other countries like Canada, Germany, and Australia have already rolled out spot crypto ETFs for years. Let's walk through how a crypto ETF works. Let's say you invest $1,000 in a Bitcoin spot ETF. Behind the scenes, the ETF provider, say BlackRock, takes that money and purchases actual Bitcoin, storing it safely in institutional-grade cold storage. You don't receive Bitcoin in your wallet. Instead, you receive shares of the ETF. As Bitcoin's market price changes, the value of your ETF shares changes with it. You gain or lose value based on the performance of the underlying crypto, but you never touch the crypto itself. It's investing made easy, especially for those who don't want to manage wallets or learn blockchain protocols. So what are the main benefits of crypto ETFs? First, there's simplicity. You can buy or sell ETFs through any traditional brokerage account. No crypto exchange needed. Second, there's security. Since you're not managing your own crypto, you don't need to worry about losing your private key or getting hacked. The ETF provider handles custody. Third, there's regulation. Crypto ETFs are financial products overseen by regulators like the SEC. That means better investor protections, clearer rules, and higher trust. Fourth, ETFs are liquid. You can buy and sell during regular market hours, and the prices update in real time. Fifth, there's tax simplicity. Instead of tracking every crypto transaction for capital gains, you get a standard tax document from your brokerage at the end of the year. These factors make crypto ETFs especially attractive to new investors and institutions who want in on crypto, but without the chaos. But that doesn't mean crypto ETFs are risk-free. Let's talk about limitations. For starters, you don't own the crypto. That means you can't use it for decentralized finance, DeFi, you can't stake it for rewards, and you can't transfer it to a digital wallet. Also, crypto is still volatile. A crypto ETF might protect you from some operational risks, but it won't protect you from market swings. If Bitcoin drops 20%, your ETF shares are going to feel it. Most ETFs also charge management fees, typically around 0.5% to 1% annually. Over time, that adds up. And if the ETF is based on futures, your exposure might not perfectly match the underlying asset. You could see tracking errors or underperformance compared to the spot market. So while crypto ETFs are a great tool, they're not a magic bullet. Understanding the product is essential before investing. So, should you invest in a crypto ETF? If you're new to crypto and want a safe, familiar, and regulated way to gain exposure, yes, crypto ETFs are a great place to start. They offer a simplified path to participate in one of the most exciting asset classes of our time. If you're a long-term investor looking to diversify your portfolio with a small allocation to digital assets, crypto ETFs offer convenience, trust, and accessibility. But if you want to fully immerse yourself in crypto, staking coins, earning yields, using decentralized apps, then direct ownership may be a better fit. Either way, crypto ETFs are opening doors, creating access, yishuan, and helping to shape the future of finance. Success in crypto doesn't come from chasing hype. It comes from understanding the game. And now that you've got the basics of crypto ETFs, you're already ahead of most beginners. If this video helped you see the bigger picture, smash that like button. Subscribe for more no-fluff breakdowns on crypto and finance, and let us know what should we cover next. NFTs, DeFi, blockchain basics? Drop your topic in the comments, and we might feature it in our next video. Knowledge is power. Use it. See you next time.